Hopefully, the Adani Hindenburg fiasco taught us a lot of lessons. But for me, particularly, there are two key lessons that stand out. Number one, a reminder that our money is our own responsibility and that we should be well informed before making any investment decisions. And number two, just like it was alleged in the case of Adani companies, if the promoter is morally flexible and they try to pull out money or siphon out money from the company, usually that will show up in the related party transaction section of the annual report. So in this video, we're going to do a deep dive on how to uncover potential fraud using related party transactions or RPTs. Now, RPTs are kind of like the Shakti Kapoor of the corporate world in that if anything wrong is happening within the company, usually it'll show up in this section. And just to give you an overall perspective on why it is important to analyze RPTs anyway, right? It actually falls under the management analysis section of the overall stock analysis process. So if you look at this diagram, stock picking is a step-by-step process, right? First you screen from a large universe of stocks to a handful of stocks that you want to look deeper into. Then you do their industry business management analysis. Then you figure out whether they're cheap, fairly valued, undervalued. You invest in them based on that, and based on your outcome you try to optimize the whole process. So that's kind of like the process, right? And management analysis is where analyzing RPTs is super critical, because it actually helps us understand the quality and the character of the management, right? Now, for you who might be curious, we've actually created two videos, in-depth videos on step number one. And overall, the idea on this channel is to make videos on every step of the stock picking process over time, right? But we've made two videos. These videos are intensive. We recommend you check them out if you are curious. We've also created a free Excel template. This basically allows you to use a very powerful feature in screener.in, which allows you to download data in a preset format. This allows you to save loads of time. So you end up analyzing companies in less than 2 to 3 minutes. This is a free template. You can download it, no issues, right? Now, coming back to the original question, which is what are related party transactions and how do you analyze them? As far as the technical definition of RPTs is concerned, it's actually defined by the Companies Act, the relevant accounting standards, and SEBI's listing obligations. Now, I don't want to get into the technicalities of it, but basically, promoters and companies are very smart. They try to find, loopholes within the definition of RPT so that they don't have to declare it. And on a very large scale, we have a great example that's coming up in the video, which is of Sun Pharma. Now, what we've done for the purpose of this video to make things simple, to keep a balance between, going in depth and also, not making the video 1.5 hour, 2 hour long. What we've done is we've broken down into the different types of related party transactions. So for example, the first one would be when company gives loans to promoters, right? The second would be when promoters buy or sell assets from or, buy from or sell to the company. And between these two, I think these are the most common types of related party transactions. The third one would be when companies give advances or security deposits to promoters on generous terms, when promoters enter sale, purchase, contracting with promoter-related entities. This is a very interesting one. We'll see a case study on that. The fifth one would be when promoters own competing businesses. Would you believe it? But yeah, there are companies that do that. Number 6 would be when companies provide guarantees on behalf of promoters. Number 7 would be when companies do not disclose RPTs at all. And I think this is probably where most of the companies within India are currently lie, because most of them are not even declaring RPTs. And the eighth one, which is super important, is how much promoters pay to themselves. So these are different types of related party transactions. But what we'll do is, because we have to strike a balance between, in-depth and time, we're going to look at 7 to 8 case studies that will be from these 4 types of related party transactions. The first example of when a company has given loans to related parties of the promoter and not gotten the money back is from Escorts Limited. Now, Escorts is an agri, farm and railway equipment manufacturer. It's a very large company, around 27,000 crores as of, I think, the latest closing price. And in 2017, you see a transaction where 2.93 crores was the advances, or basically a loan given to related parties, which was not received back. We know that because right underneath that they've written allowance for doubtful advances. How innocent it sounds, right? Allowance for doubtful advances. What it basically means is you're not getting your money back, right? But so if you look in the larger scheme of things, you might say 2.93 crores is not a big deal when it comes to a company that's 27,000 crores. And I think that's a very valid point. But there are other instances in the past where the company has given loan to related parties and kind of written off those loans and not gotten it back. So in 2005, we see that there were three companies that were granted loans of total 12.51 crores. Out of that 12.51 crores, outstanding was 11.55. So they kind of paid around 1 CR. By September 30th, 2005. And finally, this is the auditor's report, by the way. And the auditors have said that, as explained, the loans outstanding repayments are not possible because of the financial constraint of these companies. And in view of that, basically, out of that 11.55 crores, 6.91 crores will never be paid back. Right? So that's not a small amount of money. I believe in 2005 dollar terms, that would be north of 1.5, maybe even $2 million, right? If I'm not wrong. Another instance comes from 2019 when the amount is much larger, where the company had given inter-corporate deposits, another way of giving money to related parties. And they said that 25.17 crores was a bit doubtful, they might not get back. And they also made a provision for that doubtful ICD, right? Which means 25 crores was not coming back to the company. So these are different instances of how a company has given off loans and actually written off those loans. Now the next case study is of Rain Industries Limited. Now, Rain Industries is a very interesting stock because I remember in 2016 it was being touted as the next big stock pick from Mr. Monish Pobroy, who is a very accomplished investor. And a lot of investors follow this strategy of copying whatever great investors are buying. But that has its own problems. So, for example, if you look at what happened in 2016-17, the stock price really shot up because everybody's interest in the stock grew and a lot of people were interested in buying into it. Following that, as you can see, the stock really hasn't given any return. So there are major casualties that can happen when you try to follow this approach, right? But Rain Industry is super interesting because in 2018, it said that we had given advances, again a form of loan, to Rain Enterprises Private Limited, a sum of 230 crores. And they said within the year we actually got that money back. So this again can be looked at a way of sort of short-term funding, and that to free short-term funding at the cost of minority investors. But again, that's not really that big of a deal. Let's look at 2017, what happened. So in 2017, they'd given a loan of 443 crores and received only 396 crores. Now, the interesting part is that this entire transaction of 443 going, 396 coming, that this transaction is not there at all in the annual report of 2017. This shows up in the annual report of 2018, right? And so now the question is, where did that remaining around 47 crores of money go? And there was no mention of it in 2017. And in 2018, they said that, oh, we've actually purchase of services. They probably spent the money or, extracted the money or whatever. And they said, okay, now we got to show something, right? And so they showed it as purchase of services from Rain Enterprises Private Limited, right? Of 47 crore rupees. So this is another example of how, promoters can siphon out money. The next company, IST Limited, is also super interesting for me personally because I remember in 2016-17, relatively new investor, and I discovered this company and it was trading at a very cheap, around, if I'm not wrong, like 3, 4, 5 times price to earning ratio. And I really thought, I've found it, I'm the next Warren Buffett, all of that. But luckily, I never ended up investing in them, in the company. But I do remember looking at the company and saying that, wow, the operating profit margins are so high. They're consistently around 70%. This must be a good company doing well, all of that. But for one reason or another, I don't think it was wisdom on my part, but I never ended up investing because frankly, I didn't really understand it that much. And also, what the company does is they're themselves confused. They say their legacy business is auto components manufacturing. They're now into real estate, They also have a software vertical, so they're a very confused kind of company. But what this company is, this case study, it's a great example of how the company has given a loan to its related entities at a very relatively cheaper interest rate, right? Again, why that matters is because if you're borrowing from the bank or the some financial institution at say 9.50, which is the case in this case, as I'll in this company, as I'll show you, and actually giving a loan from that amount to a promoter entity at say 7.75 or 7.5, it's basically putting the burden onto the minority shareholders at the expense of the promoter, right? Now, again, coming back to this, so these are two entities that received a loan of around 8.11 crores, and on that they received an interest of 62 lakhs, right, which is around 7.75%. And as I said, the company in the same year, around the same time, was borrowing at 9.50%. So when you're borrowing at 9.50 from the financial system and then taking that money, and lending it to yourself at 7.75, that's a little bit shady. The next company is Datamatics Limited, and this is interesting because it's actually the opposite of IST. In the case of IST, IST is actually the company IST had lent money to its related parties at lower than usual interest rates, right? In this case, what they've done is they've received loans from the promoter at higher than usual interest rates. So on the screen, you can see that from loans, they've actually borrowed, abroad in the form of external ECB's external commercial borrowing, which is a dollar loan, and they've borrowed around 24.6 crores. Right now, the rate of interest on that borrowing is LIBOR plus 3%. So LIBOR is basically London interbank overnight rates. So basically, the rate at which banks within London kind of lend to each other, right? Plus 3%. Right, which is a convention. So that's the interest rate that they were borrowing at. At the same time, they took a loan from the promoter at 9%. Now, just to compare what LIBOR was, if you actually check the LIBOR rates at the time around 2016 March, so for a 12-month LIBOR was 1.21%. So obviously, the longer the term of the loan, usually the rates will also be higher. So if it's a 3-year loan, it will, it might be around 1.5%, even 2%, right? So add 2% plus 3%, which is the rate that they were borrowing at, comes to 5%. When they're able to borrow at 5%, why is it that they've taken a loan from the promoter, from the director, at an interest rate of 9%, right? Again, the extra 4% is a burden on the minority shareholders and is a way of kind of, in a relatively minor way of siphoning money out. Now, again, another interesting aspect is the company actually had cash on its books. It had cash of 61.5 crores. When you're already a cash rich company, what is the need to borrow from the director, right? So these kind of transactions raise a lot of doubts about the character of the management. So far, we've discussed the first type of related party transaction, which is when the company gives a loan to promoters. Now, we've looked at two different variations of this. One is when the loans are given and those loans are written off. Those loans are given at interest free. And the second is when loans are given at an interest rate and the interest rates are such that they are designed to benefit the promoter at the expense of the minority shareholders. Now what we're going to do is we're going to move to the next section, which is when promoters buy or sell assets from or to the company. And in the last video on Adani Hindenburg, we actually discussed this example where Gromor Investments, right, invested in 2010 128 million in a private entity owned by the Adani Group, Adani Maharashtra, for a 26% stake. 1 year later, that same stake of 26%, which it paid 128 million for, it received $551 million from Adani Power, which is a publicly listed company. So effectively what happened was that Adani Power, being a publicly listed company, paid 551 million for a stake that cost 128 million. Now you'd think Gromor Investments on their part did a great job because they paid 128 million. 1 year later, for the same investments, they received 551 million. The plot twist is that Gromor Investment was actually, it turns out, a related party, not in maybe the technical terms, but as far as the influence, the Adani Group exerted the influence. Well, they pretty much controlled Gromor Investments. So it was basically like paying yourself $555 million of the money that partly belonged to the minority shareholders of Adani Power as well, right? So going along with that, a similar example comes from Globus Spirits. This is a country liquor manufacturer. And what Globus did was it paid 45.26 crores to a company called Associated Distilleries. It's not even a company, it actually paid it for one unit. So it was a unit, a manufacturing unit, alcohol manufacturing unit. And it paid this 45.26 crores for a company, Associate Distilleries, which had a book value, right? Book value of 9.91 crores. Now, this is not really that extraordinary, nothing wrong so far, because usually book value does not really represent the true value of the company. So it's not very uncommon that a company that is acquiring another company or a manufacturing unit would pay a multiple on the book value or pay a multiple of the earnings, right? Again, plot twist, it turns out that Associated Distilleries is actually a company owned by the promoters themselves. So effectively, what they've done is they've taken money from the public company where minority shareholders also have a stake, and they took the money and paid themselves, right, a relatively exorbitant amount. And in order to showcase that yes, this 45 crores was a reasonable number to pay, they actually propped up the PAT numbers, profit after tax numbers, in the last 2 years before they acquired, this company. So in 2007, 8, 9, we can see that the earnings profit after tax is 54 lakhs, 51 lakhs, 43 lakhs. Suddenly in 2010, it becomes 6.4 crores. And then in 2011, when the acquisition actually took place, the profit after tax was 12.6 crores. So when you look at 45 crores as a multiple of say 12 crores, 12, 3.5 times, 4 times, whatever, you say, well, that's actually not a bad price to pay, because if you're buying an asset that's giving you 12 crores per year, 45 crores paying for that is absolutely a phenomenal number. The problem is that another plot twist. So 3 years later, the auditor flagged or auditor wrote in their report that there is a plant and machinery, which is basically this unit that they had bought, Global Spirits has bought from their own owners, which is worth 32.78 crores, which is lying there on the books, and it has been totally unutilized over the last 3 years. So as soon as the acquisition happened, this unit was basically rendered useless, right? So again, a great example of how Global Spirits, the promoters, have actually shifted money from the public company to their private entity at the cost of obviously the minority shareholders, right? Now, the next example we're going to look at is Finiotex Chemical. Companies give advances or security deposits to promoters on extremely generous terms. And here we have the example of a company called Finiotex Chemical Limited. This is a 2,000 crore market cap kind of company. And we see here that Kanaklata Tibrewala, which is basically the wife of the promoter, she received 7.88 lakh rupees in the form of rent from the company. And in another section of the report, the annual report, we find that for this rented premise, the company also paid to the lady basically a total sum of 1.95 crores. Right, so usually you pay a security deposits when you're using it for personal use. You might pay 3 months of security deposit as advance. In commercial, you might pay 6 months, 9 months at max. And here you have a case where the company is paying 25 times, and that too interest free. Right, so this is a clear case of shifting economic benefits from the company to the promoter. The fourth type of RPT we're going to discuss now is when promoters enter a sale, purchase, or contracting type of agreement with promoter related entities. And this is where the Sun Pharma example comes in. Now, in 2018, Sun Pharma suddenly declared that they have a related party, Aditya Medisales, with which they've had significant related party transactions. And this really annoyed a lot of investors and stakeholders for two reasons. One is that Aditya Medisales, first of all, it's not as if this company appeared out of nowhere, right? It was always controlled or to a large extent by Sun Pharma and the promoters, but it was never declared as an RPT up until 2018. So that really annoyed a lot of stakeholders. And secondly, the company itself, Aditya Medisales, if you look at the income statement of the company, it displays a lot of characteristics of a shell kind of company, right? The reason is it had 8,000 crores of sales, right? 8,000 crores of sales, whereas, and this company with 8,000 crores of sales was supported by employees who were paid only 2.22 crores, right? This is simply just unbelievable, especially when you consider the fact that Aditya Medisales would have large size, storage units with kind of state of the art storage technology, all of that, and with only 2.2 cr of employee expense, that just does not make sense, right? So that's one thing that pissed off. Secondly, was why was it not declared as an RPT up until 2018? And the promoters of Sun Pharma actually used a technical definition to avoid declaring Aditya Medisales as a related party, right? And what the way it worked was, so basically there's an idea of significant influence, right? So if you exert significant influence over a company, you're liable to declare it as a related party. And significant influence, let's not get into the definition on, but basically it depends on ownership. So if you're over 50%, anyway, it's very obvious that you're controlling the company. But the way the promoters, right, the Dilip Sangvi and family, the way they kind of got around this was they directly owned in their name around 9.98 and 1. So nearly 19% of Aditya Medisales, right? This was them directly owning it. So technically, right, they owned less than 20%, which does not fit the definition of exerting significant influence, and therefore, on technical basis, they were able to avoid declaring Aditya Medisales as their own company, right? But the reason why they got away was because ultimately they were using other companies through a large chain of investments, right? So the ultimate owner was still Dilip Sangvi and family, but they could not be discerned as the ultimate owner, right? Because they were hiding behind, different layers of companies that were holding stake in Aditya Medisales. So obviously this was a very obvious case of wrongdoing. If you want to learn more about this, there's an article by Bloomberg Quint. I'll leave it in the description. You can check it out, get more details and clarifications. But SEBI actually found this out, and SEBI investigated, and SEBI found them guilty for this violation. And now my question to you is, let's make this interesting. If you're still watching, first of all, please do consider subscribing. But if you're still watching, now my question to you is, how much do you think SEBI actually fined promoters of Sun Pharma, right? So right now, whatever number comes to your mind, please leave it in the comment box. It'll be fun. Let's just whatever number comes to your mind. Surprisingly, SEBI fined Sun Pharma a total sum of 56 lakh rupees, right? The company was fined 56 lakh rupees. Now, just imagine the magnitude or the crores and crores of rupees that potentially could have been, shifted from the company at the expense of the minority shareholders to the promoter entities, and you just get away with it, right? That's just how it is, right? So yeah, it's one of those large scale examples after Adani recently, right? And hopefully it has been somewhat instructive. Now, finally, we come towards the end of this video. Hopefully we've looked at some interesting examples. As we said earlier in the video as well, we've actually looked at examples and case studies only from the first four categories of related party transactions. The remaining, what I want to do is I want to create a directory, so which is going to be like a blog, right, where I'm going to be adding more examples and just keep building that directory over time, so that people as an investor, you can come and have a large data set and look at different types and examples so that it can help you in your investment journey. I also have a request that if you come across any examples where such kind of transactions have happened, please do share them with me at info.firstprinciplesinvesting@gmail.com. Again, I'll leave the email address in a comment or in the description. So it'll be nice that we can kind of contribute and build a directory over time. So I think that will be super, super interesting. With that said, hopefully this video has been useful. If you're still here, please consider subscribing, and I'll see you in the next video.